In today's mobility industry, growth is no longer the real measure of success. Companies are expanding rapidly, but only few are actually turning that growth into real economic value. Aurora Mobility Group is one of those companies where revenue is rising, operations are expanding, yet beneath that growth, something is fundamentally not working, and the company is doing more but capturing less. And that is exactly the challenge we are going to unpack today. Hello everyone, this is Saida. Today, together with my team, we will guide you Aurora Mobility Group's journey from its current strategic challenges toward a path of sustainable competitive advantage. The key question is not whether Aurora is growing, but why that growth is failing to create value and what must change. So to answer that, let me begin with a brief overview of Aurora's current situation. Aurora Mobility Group has evolved from specialized engineering firm into diversified global mobility company operating across hardware, battery system, mobility services, and software platforms. Over the past few years, the company has experienced strong revenue growth, increasing from 2.24 billion to 3.34 billion growth, reflecting its expanding presence in the mobility ecosystem. However, this growth is not translating into sustainable value creation. The issue is not demand, but a deeper structural challenge within the company's business model. At the same time, the industry is shifting toward platform-based value creation, where software and data-driven capabilities are becoming increasingly critical. In Aurora's case, these high-margin software capabilities remain underutilized, where capital-intensive and mobility services continue to dominate the revenue structure. This leads to key insight that Aurora is growing, but its structure is misaligned with whether the value is being created in the industry. Ultimately, the challenge for Aurora is not growth, it is strategic misalignment. If we look at Aurora's performance more closely, the data clearly supports this problem. Financially, revenue is increasing, but profitability is under pressure. Operating margin is lower than industry, which signals a pure profitability gap, and net margin is also lower. At the same time, free cash flow remains weak. From an operational perspective, inventory turns 29% slower than benchmark, which means capital is really trapped in warehouse, indicating insufficient use of assets and high capital intensity. But the most important insight comes from the segment breakdown, which is hardware contributes over half of total revenue but delivers low margin, and mobility service generate very limited returns. In contrast, the software platform has highest margin 23.6% but contributes only a small portion of total revenue. This clearly highlights what we call the value gap within Aurora's business model. So Aurora is scaling low value segments while under leveraging its highest value capabilities. As a result, growth is structurally diluting returns rather than enhancing them. To understand why this is happening, we applied the Vero framework to evaluate Aurora's internal capabilities. The software platform represents a latent strategic core advantages for Aurora. It is valuable, rare, and difficult to imitate. However, it is not fully prioritized or integrated within the company's strategy, which means Aurora is not able to fully capture its potential. In contrast, engineering and brand provide only competitive priority, while battery systems are constrained and mobility services deliver limited strategic value. While we are good at engineering, so is everyone else. It is now just the price of entry rather than a way to win. So the key takeaway is that Aurora's strongest resource is not fully organized and therefore not driving its competitive advantages. So Aurora's problem is not capability, it is alignment. And building on this insight, my fellow team member will guide us through the strategic direction where Aurora should pursue.
Hello, I'm Umme Kulsum and I'm going to talk about SWOT analysis and strategic direction. So, starting with the SWOT analysis, what's important here is that we are not just listing strengths and weaknesses, but actually understanding the strategic misalignment within Aurora. On paper, the company looks strong. It has a high margin software platform, solid engineering capabilities, and consistent investment in R&D. But the problem is not capability, it's where the company is focusing those capabilities. Aurora is still heavily invested in capital intensive hardware and low margin services, while its most valuable asset, the software platform, remains underutilized. At the same time, the external environment is shifting toward platform based ecosystems where value is driven by data, integration, and scalability. So, the key takeaway is that Aurora has strong capabilities, but they are not aligned with where the industry is creating values. Moving to the strategic synthesis, this misalignment becomes even clearer. There's what we can call an inverse alignment problem. The segments that generate the highest value, like software, are underweighted. Meanwhile, lower return segments dominate the company's resources. As a result, Aurora participates across the mobilities ecosystem, but it doesn't actually dominate any of the most valuable layers. So, the strategic shift needed here is moving away from diversification and towards strategic concentration. That means focusing on platform and data capabilities while repositioning hardware as support and reducing or restructuring low value services. Finally, in terms of strategic direction, the main issue is a lack of strategic coherence, not a lack of opportunity or resources. The recommendation is to adopt a platform centric strategy where the software platform becomes the core of the business. Other options like vertical integration, expansion, or acquisition either increase cost or complexity without solving the core issue. This strategy works because it aligns Aurora with its highest margin, most scalable segment, improves capital efficiency, and allows the company to move into a stronger position as a platform leader. So, overall, the goal is to shift Aurora from being just a manufacturer to becoming a mobility platform orchestrator, controlling the layer where real value is created. Thank you so much. My next group member will present the next topic.
Now that we have come up with the platform centric strategy for Aurora, now we'll be thinking about how to implement this in the operational floor. For that, we'll be discussing about phase execution and about the risks that might come in the operation system and how we can mitigate them. Hello everyone, my name is Sumaya Hassan Ahana and I'll be talking about the risk mitigation and the outcome of the strategies. For the first phase of execution for Aurora would be stabilization. This is for a very short term period. The main issue for this phase is the inventory turnover rate, which is very low right now, and the asset utilization is also very weak, which is why our focus is very simple at this point. We'll be reducing the cost and improve the efficiency and stabilize the operation. At the same time, the supply chain, it also needs to be worked, especially on the batteries. That is a very big concern that needs to be worked on right now, and most importantly, the leadership needs to be aligned, because without that the strategy won't work. At the second phase of the execution plan, we have reallocation. At this point, we can see from our case that the VRIO framework has indicated the software is the strongest resource for Aurora. We'll be working on that. For that, we'll be investing more in the software and data. We'll be working more on the AI, and this way we will be reducing the business roles, and thus the relocation will be implementing from 1 to 3 years in the company, and the result will be showing the scalable growth within the company. And the last phase for the execution plan is the ecosystem. This is the longest period of time. This will be taking more than 3 hours. At this point, we'll be focusing on the smart ecosystem. In this way, we'll be having more partnership we'll be having more partnership with our suppliers, and this will eventually leverage the data and network effects, and this also will have a long-term effect with sustainable advantage for the company. That the first risk we are facing here is the organizational resistance, because we are moving from traditional hardware to software, which is why
which is why to mitigate this risk, we have to have the alignment within the incentive and leadership commitment. The next one is technological risk, and this one is for Aurora. This is very different than other manufacturing companies, which is why the phase development and the partnership with other suppliers is very important. The next one is market adoption. So for market adoption, we are here planning for a niche market, a small for a small city to start the pilot project with. This way we can have a clear data and clear result from our strategy. The next one is competitive pressure. For this one, we can see that there are already many reputed tech firms and big companies existing in the market. This is a very big risk for Aurora. To mitigate this one, we are focusing on niche leadership first. The next one would be financial risk. At this, the main risk here would be the misallocation of our resources and this investment. That is why our investment needs to be very controlled, and the milestone based investment discipline will definitely help Aurora to mitigate this risk. And the last one is supply chain. As we can see that supply chain has been a very difficult issue with Aurora. That is why our supply chain needs to be very diverse, which will help us to overcome with the controlled supply chain. Now we'll be talking about the execution outcome. The first one is the platform centric shift. This shift is really about putting the strongest part of the business at the center. This is leading the company with high profit, high margin profit, and of course scalable platform model. And the second one is the performance improvement. This one is directly solving the issues that we had identified earlier, where the growth was existing but the value creation was very weak. So with performance improvement, we can see the identical increase in the profit, and there are more clear strategic focus. Once the performance improvement is showing the result, now we can come up with the strategic position. At this point, Aurora is positioning with a very solid and at a very with a very strong foundation in the market itself. Now it has diversified itself from a manufacturing company into a complete repositioning company. To conclude, we can see the competitive advantage that is coming from our strategy. The first challenge was not the lack of growth, but the misalignment between where value is created and where resource is allocated. And of course, the industry is now shifting towards platform-based competition, where software, data, and ecosystem control is defined success. And lastly, the alignment within the resource allocation, it is leading the way, where the platform-centric strategy with selective integration is the most effective path forward for the Aurora.